Welcome, curious minds, to the deep dive. We live in this incredibly dynamic world of tech and social media, right?
Mm.
Companies are constantly pushing the boundaries, innovation.
Absolutely, all that shiny new tech.
Exactly. But underneath, there's this complex financial reality they have to navigate. And, a whole host of risks that can shift things almost overnight. How do we even make sense of it all without getting buried in reports?
Well, that's pretty much why we're here. We take that stack of information, official filings, research, and we distill it down, get you the most important nuggets of knowledge, the key insights.
Think of it as your express lane to being really well informed.
Yeah, exactly. Maybe with a few surprising facts, keep you hooked.
Love it. Today, we are taking an in-depth look into Snap Inc., the parent company of Snapchat.
Mm-hmm.
And we're not just, sifting through numbers. Our mission is to help you understand the forces shaping one of today's big social platforms.
Right. From user growth, their kind of unique corporate structure, to the challenges they're facing.
Yeah. You're about to get a clearer picture, a concise understanding of a company that, touches millions of lives.
And our main source for this deep dive, it's Snap Inc.'s latest quarterly report, specifically their Q2 2025 Form 10-Q.
Okay.
So this is the official document filed right with the U.S. Securities and Exchange Commission, covers the quarter ended June 30, 2025. It's the company's own detailed account of its, financial health, what's going on operationally.
So what does this all mean for you listening? We're going to break down Snap's financial performance, revenue streams, their strategic investments, and, those significant risks and opportunities ahead.
Giving you that comprehensive view beyond just the headline.
Exactly. Ready to zoom in on their latest quarter. Let's maybe start with a high-level snapshot. Q2 2025 performance.
Okay.
All right, let's set the stage a bit. Snap Inc. They're based in Santa Monica, California. Trade on the New York Stock Exchange. Ticker is SNIP.
Right.
And they're categorized as a large accelerated filer. What does that actually mean for us?
Well, it basically means they're a substantial company. They meet certain size thresholds. And it also means tighter reporting deadlines, more regulatory scrutiny.
Okay, so more transparency.
Generally, yeah.
Yeah.
A higher level for investors. And the good news, they've filed all their required reports on time. So plenty of data for us to dig into. Is, critical for social media platforms.
Always the first thing you look at.
Right. Snap reported a pretty strong 9% year-over-year increase in daily active users, DAUs.
9%, okay.
Yeah, it reached an impressive 469 million in Q2 2025. So continued solid community growth there.
Okay, 469 million daily users. That's a lot of people. But then you look at the average revenue per user, the ARPU. What's the story there? Because despite that DAU growth, ARPU was, kind of flat year over year. $2.87 in Q2 2025 compared to $2.86 the year before. What's that telling us?
Yeah, that's interesting, isn't it? It suggests their main challenge isn't really getting users anymore. They're clearly still bringing people in.
Right, the growth is there.
The growth is there. The challenge is deepening monetization for that growing audience. They're getting more eyeballs, but not necessarily squeezing more money out of each eyeball. Not yet, anyway.
So what could they do?
Well, it could push them to diversify ad formats, maybe, or perhaps push things like Snapchat Plus more aggressively, those higher value subscriptions.
That makes sense. That's a crucial insight. Now, looking at the overall financial performance for the quarter, the top line revenue increased 9% year over year.
Yeah, just over $1.3 billion, up from about $1.2 billion.
Okay, so revenue's growing. But the company reported a net loss of about $263 million.
Right.
Which actually got bigger compared to last year's Q2 loss of around $249 million.
Right.
Looking at those numbers, how concerned should people be about this continued unprofitability, even with revenue going up? What's the tension here?
It's that classic growth company balancing act, isn't it? While the net loss increased, which isn't ideal, it's also important to look at adjusted EBITDA.
Okay, explain that one quickly.
Sure. Earnings before interest, taxes, depreciation, and amortization. It's a common way to look at sort of core operating profitability before financing stuff or non-cash charges.
Got it. And how'd that look?
That also decreased, down to about 41 million from 55 million the year before. So that implies that even at that operational level, the core business became slightly less profitable this quarter. Despite the revenue bump, the tension is really investing for the future versus making money today.
But, okay, there were some really positive shifts in cash flow. which, people often say is a better health indicator than just net income.
Definitely. Cash is king, right?
Right. Cash flow from operations turned around dramatically. They went from using about $21 million last year to providing over $88 million in Q2 2025.
That's a big swing.
Huge swing. And their free cash flow, that's a positive shift too, reached almost $24 million, up from negative $73 million in Q2 2024.
Yeah, substantial improvement.
So even with the net loss, their actual cash generation from running the business looks much healthier.
That's absolutely right. That positive free cash flow, it's a vital sign. It indicates the company is generating enough cash from its operations to cover its operating expenses and capital expenditures, investments in equipment and stuff.
And liquidity-wise, how much cash do they have on hand?
Pretty solid. As of June 30th, Snap held about $2.9 billion in cash, cash equivalents, and marketable securities. Gives them a nice cushion. Strong liquidity position.
Okay, $2.9 billion, that's reassuring. Now, to really understand the health, we need to dig into how they make money and what they spend it on.
Yeah, the revenue streams and expenses.
Let's break that down. Looking at Snap's revenue, the vast majority, like over 87% in Q2, still comes from advertising.
No surprise there. That's $1.17 billion.
Right. They do have that other revenue category subscriptions like Snapchat plus hardware sales.
That was about $171 million.
Yeah. And while it's growing, the report itself notes it's not material to total revenue.
Not yet, anyway. Advertising is clearly still the main engine.
Definitely. Okay, pivoting to costs. Several areas are on the rise. What's the picture here?
Well, it really paints a picture of a company investing heavily. Investing in its infrastructure, its foundation, and also future growth engines like AI and machine learning.
Even if it hurts profits short term.
Exactly. So, for instance, cost of revenue increased by about $64 million or 11%.
Why?
Primarily higher infrastructure costs. That's driven by the DAU growth. We mentioned more users need more server power, basically. And also those big investments in ML and AI.
Okay. What about R&D, research and development?
That also rose, up by about $37 million or 9%. Again, reflects investments in developing new products, features, and also higher employee compensation, more R&D staff.
Although that was partly offset by some restructuring charges from last year, right?
Correct. They had restructuring charges in Q1 2024 that make the year-over-year comparison look a bit different. Same applies to G&A, general and administrative expenses.
Right. G&A up about $21 million, 9%. Mostly higher spending on external services like legal fees.
Also partially offset by those 2024 restructuring charges. It gets a bit complex comparing years when there are one-off charges like that.
Okay, but interestingly, sales and marketing expenses actually decreased, down $8.5 million, about 3%.
Yeah, that one stands out a bit.
Why would that be? Driven by lower advertising costs, it says, even though they increased headcount in sales and marketing.
Yeah, and again, impacted by those restructuring charges from Q1 2024.
That feels a bit counterintuitive for a company focused on growth. What might they be signaling by pulling back on marketing spend, even with more marketing people? Is it efficiency or something else?
Could be a mix of things. It might imply they're seeing more organic growth, maybe, or perhaps a better return on the marketing they are doing so they can pull back a bit without hurting user growth too much.
Okay.
It also suggests maybe a focus on internal efficiencies, like reallocating resources within the sales and marketing teams rather than just big external ad campaigns.
Interesting. Now let's talk interest. There's a really notable shift here. Interest income decreased slightly, about $3 million. Lower interest rates, makes sense.
Right.
But interest expense, that soared. Up $22.5 million, which is like 440%.
Whoa. Yeah, that's a big jump. The report says it's primarily from additional interest on new debt, those 2033 notes they issued back in February 2025.
Okay, so taking on new debt is costing them more in interest payments.
Makes sense. And looking quickly at other income and expenses, Q2 saw a small net expense, less than $1 million.
But for the first half of the year.
For the 6 months ended June 30th, there was actually net income of about $48 million in this category. That was largely driven by a big gain, $66.9 million on debt extinguishment.
Debt extinguishment? What's that?
Basically, buying back their own debt for less than it was worth on their books. We'll get to that. That gain was partially offset by about $13 million in net losses on some strategic investments they made.
So it shows their finance teams being quite active, managing the balance sheet, using debt moves to offset other losses.
Yeah, definitely some active financial management going on, not just letting things ride.
Okay, great point. Let's follow that money flow then. Cash, debt, shareholder stuff.
Yeah.
As of June 30th, Snap had $3.5 billion in outstanding debt.
Right. Mix of senior unsecured notes and senior convertible notes, maturing between 2026 and 2033.
And the future interest payments on that debt are pretty substantial. Over $113 million short-term, nearly $740 million long-term.
Yeah, that debt load isn't insignificant, and those convertible notes are interesting. They can be converted into cash or Class A common stock, but it's at Snap's choice.
And crucially,
The report explicitly says the conditions for holders to force a conversion weren't met for Q3 2025. So holders can't demand shares right now. Snap holds the cards on conversion timing.
okay. Now, what's really fascinating is how they're managing this debt. You mentioned debt extinguishment.
Right. Back in February 2025, Snap repurchased $1.4 billion worth of its older notes, the ones due in 2026, 2027, and 2028.
Okay.
And they bought them back at a price that was $190 million below their carrying value on the books.
So they bought their debt back at a discount.
Exactly. Which resulted in that $66.9 million gain we mentioned earlier. They essentially booked a profit by retiring debt cheaply.
Clever. And how do they fund that repurchase?
Primarily by issuing $1.5 billion in new debt. Those 2033 senior notes we talked about. The ones causing the higher interest expense.
So they're shuffling debt around,
Mm-hmm.
pushing maturities further out, even if it costs more in interest now, and snagging a profit in the process. Active management, like you said.
Precisely. Optimizing their financial position. Extending those repayment timelines.
Okay, what about shareholders? Capital management on that side.
Well, they completed a $500 million stock repurchase program for their Class A common stock back in May 2025.
Buying back their own shares?
Yep. They repurchased and retired about 57.3 million shares for just over $500 million in the first half of 2025. They did a similar program back in Q2 2024, too.
And what's the typical reason for buybacks?
Usually it reduces the number of outstanding shares, which can boost earnings per share for the remaining shares. It can also signal management thinks the stock is undervalued.
Got it. And then there's this planned future stock split. But it sounds complicated.
Yeah, it's definitely not guaranteed. It's structured as a special dividend, but it's contingent on two very specific and kind of complex triggers.
Lay them out for us.
Okay. First, the average stock price, technically the volume-weighted average price, or VWAP, of the Class A stock, needs to hit $40 or more for 90 straight trading days.
90 days at or above $40.
Yeah. And second, this is the really complex part, the ratio of that 90-day average price to $8.70 has to meet or exceed the ratio of the S&P 500 total return index to a specific number, 8,862.85.
Wow. Okay, so it's not just hitting a price target. It's hitting it and outperforming the market significantly over that period.
Exactly. It's a relative performance trigger, too. And if both those things don't happen by July 21st, 2032, the split just doesn't happen.
That is an elaborate setup. What does that tell you about management's thinking?
Confidence.
Caution.
It feels like an incredibly high bar. Think about it like this. They're essentially saying, we'll give you more shares, but only if we achieve truly exceptional, sustained growth and market outperformance over a long time.
Right. Not just a temporary spike.
Exactly. It speaks to a long-term, ambitious view, maybe, but also a desire to avoid splitting the stock if it's just, treading water or underperforming.
Right.
Only reward shareholders if things go exceptionally well.
Makes sense. And dividends. Any cash for shareholders.
Nope. The company says it's never declared or paid cash dividends and has no current plans to. They prefer to reinvest earnings back into the business for growth.
Which aligns with that long-term strategy focus.
Yeah, fits the narrative.
Okay, let's shift gears slightly. Let's talk about navigating the headwinds. Because like any big tech company, Snap faces a ton of risks and challenges.
For sure.
First up, the macro environment. The report mentions ongoing challenges, labor shortages, supply chains, banking instability, tariffs, inflation, interest rates, geopolitical stuff.
The whole laundry list.
Yeah. It sounds like trying to steer a very expensive ship through a massive storm. How much control does a company like Snap actually have over these huge external forces? And what's the immediate impact they're feeling?
Very little direct control, really. These are macro forces affecting almost everyone. For Snap, the most immediate hit is usually advertising spend.
Right.
When businesses get nervous about the economy, they often pull back on discretionary spending. Advertising is usually one of the first things they cut, and that hits Snap's main revenue stream directly. Big pressure there.
Indeed. And the social media landscape itself. Intensely competitive.
Oh, yeah. You've got the giants, Alphabet, Google, YouTube, Apple, ByteDance, TikTok. Meta, Facebook, Instagram, WhatsApp, Pinterest, Reddit, X.
Many with way more resources, bigger market share.
And they often copy Snap's features, too. It's a constant battle for user attention and those ad dollars.
Then there are the platform dependencies. You mentioned this briefly with costs.
Yeah, they rely heavily on Apple's iOS, Google's Android, and cloud providers like Google Cloud, Amazon Web Services.
So changes by those partners.
Changes in policies, features, pricing, anything like that could seriously harm Snap's business because they don't control that underlying infrastructure. Imagine if Apple changes App Store rules significantly or Google jacks up cloud prices. Snap has to adapt, absorb those costs.
Okay, and this is a big one. Privacy and regulatory scrutiny.
Huge.
There's increasing regulation around privacy, data protection, especially how personal data is used for targeted ads.
Yeah.
We saw the impact of Apple's app tracking transparency, for instance.
Right, ATT definitely shook things up for many ad-based businesses.
And regulators are scrutinizing personal data use, especially for teens.
Yeah.
That can lead to less ad demand, fines, maybe forced changes to how they operate.
And with all their investment in AI, that brings its own set of new legal questions, potential liabilities, regulatory inquiries. It's a minefield.
How tough is it for them to navigate this constantly shifting regulatory world while also trying to innovate?
It's incredibly complex. They have to balance pushing new features with staying compliant. That can slow things down, increase costs.
Yeah.
And privacy isn't just about today's rules. It's about anticipating what regulators might demand tomorrow, especially around younger users. Needs big investment in legal, security, adapting ad tech, all chipping away at profit.
And then there are the actual lawsuits.
Right. The report mentions various ongoing suits. A securities class action tied to that Apple privacy change impact.
And claims related to user-generated content, like addiction issues or even fentanyl overdoses happening via the platform.
Yeah, those are serious issues they face liability claims over, plus ongoing patent and intellectual property infringement claims. The outcomes are, as they say, inherently unpredictable.
Okay, shifting to internal stuff. Their strategy prioritizes long-term user engagement and innovation, sometimes over short-term profit.
Right, they state that pretty clearly.
But that carries risks. Investments in new things like Snapchat Plus or My AI might not pay off as expected.
Exactly, and the company even acknowledges their costs could go faster than revenue, leading to bigger losses. Plus, just managing rapid growth, expanding internationally, those are big operational challenges too.
Now, one of the most talked about things with Snap, its unique capital structure. Can you break that down?
Yeah.
How does the co-founders' voting control impact, say, an everyday investor buying Class A stock?
Sure. It's quite unusual. The co-founders, Evan Spiegel and Robert Murphy, control over 99% of the voting power.
Over 99%, wow.
Yeah. That's because of their Class B and Class C stock, which have super voting rights. The Class A common stock, the shares you buy on the NYSE, have zero voting rights.
Not at all.
None. So this concentrated control means the co-founders essentially dictate all stockholder decisions, approving mergers, electing directors, everything.
Which might not always align with what Class A holders want.
Potentially, yeah. And Class A holders have no say. The structure has also led to Snap's Class A stock being excluded from some major stock indexes, like FTSE Russell.
Why does that matter?
Well, some big institutional investors, like index funds, can't or won't buy stocks that aren't in those indexes, so it might make the stock less attractive to them, potentially contributing to price volatility. It's a significant governance difference.
And speaking of insiders, you mentioned Spiegel and some directors recently adopted or modified these Rule 10b5-1 trading plans.
Right. These are important. They're pre-scheduled plans for insiders to sell stock, set up way in advance.
To avoid accusations of trading on inside info.
Exactly. It lets executives manage their personal finances predictably and transparently. For instance, Spiegel's plan allows for selling Class A stock worth about $30 million over a period.
Okay. So how does that concentrated control actually play out in practice, like at the annual meeting?
Well, at the August 1st, 2025 annual meeting, the report notes the co-founders, holding that 99% plus voting power via their Class C stock, they just re-elected themselves and the other directors by written consent.
No actual vote needed from Class A holders.
Nope. And they also ratified Ernst & Young as their accounting firm the same way. It perfectly highlights that concentrated control we talked about. Decisions are made by the founders.
Okay, so wrapping things up, what have we learned from this deep dive into Snap's Q2 2025 report?
Well, you've seen a company that's kind of juggling, right? Impressive user growth, some promising improvements in cash flow.
But still dealing with those persistent net losses.
Right. And increased costs from investing heavily in AI and infrastructure. Plus, that constant battle against intense competition and those ever-evolving regulations.
And that unique capital structure really stands out too. The co-founders having almost total voting control. That's a defining feature.
Yeah. I think the key takeaway is that Snap is clearly making strategic moves. You see it in the debt repurchases, the stock buybacks. They're actively managing their finances, their capital structure.
Even while navigating this really complex and uncertain external world shaped by the economy and privacy changes.
Exactly. They're trying to position themselves for the long haul.
Okay, so as a final provocative thought for you listening, think about the implications of Snap's long-term strategy. This explicit focus on user engagement and innovation over short-term profit. In a world that seems increasingly focused on immediate returns, what does it mean when a company actually says, we'll make significant investments, and we cannot assure you that users will purchase or use such new products and services in the future?
It's a bold statement.
It really is. How might that long-term view, combined with their unique voting structure, help them, or maybe hinder them, in adapting and thriving in this constantly changing digital landscape? What else might you want to know to really understand how this approach plays out for a company like Snap? Something to think about.